Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Taking a look today at 3 reasons to finally start getting maybe a little bullish or non-bearish on Microsoft. For those who have followed me for a while, you know I've been a bear on Microsoft, certainly when it was trading at all-time highs. Now that the stock has been absolutely taken out to the woodshed, starting to get a little bullish because price does matter. We always like to, as we go through things, take our fusion approach, taking a look at the fundamental, technical, and probably most importantly, IV analysis. So let's jump in and take a look, shall we? First of all, from a fundamental basis, here are a couple of the basic valuations, PE and price to sales, right? So you can see price to sales, which not too long ago when I was bearish, hitting 14 times price to sales, now dropping to well under 10 at basically the lowest multiple of the past 3 years. PE, price to earnings, also hitting a multi-year low. I went out 5 years on this chart, under 25 for the first time over the past 5 years. You can see the last times that it hit these kind of trough valuation multiples proved to be good times to buying the stock as we had that bounce. Earnings have come out over the past 4 quarters. You can see have beaten soundly over that time frame. Yet the stock has gone absolutely nowhere. So much better earnings with a stagnant stock leads to this big valuation multiple contraction. So Microsoft certainly looking a little more attractive on a valuation basis on the fundamental side. Taking a look at the technicals, certainly starting to get overdone as far as to the downside. You can see the stock has been absolutely walloped since earnings, which were a beat, more the spending coming out that caused the consternation. But you can see the stock has been down sharply even after that gap lower on earnings, now approaching that big support level around that 390 area. So it's basically round tripped, right, since 4 earnings ago, right? And here are all those earnings beat, right? So the stock has beaten earnings 4 times in a row. That stock has gone nowhere. So we're nearing that kind of support area, the gap, right, from earnings to the upside. We'll see if that holds or not. But certainly the stock approaching oversold levels on a technical basis. 9-day RSI nearing 20 at the lowest levels of the year. MACD at by far the lowest level of the year. Bollinger percent B has been negative now for a while. You can see the previous times where it got negative and MACD was overdone, all marked significant short-term lows in the stock. And you can see, as we'll take a look further in a second, IV has actually popped up post earnings. We saw the usual vol crush when earnings were released, but we've seen earnings now approaching the same level as before they were released. So that sets up ideally for some trades here. And speaking of implied volatility, we always like to take a look at that. Here is the 60-day IV. You can see now trading back at the highest level we have seen since back in April, right? So IV basically at the highest level over the past 6 months. We'll take a further look at a second. You can see the current IV from yesterday in red to or 2 days ago in red to yesterday spiked much higher. So we saw this huge pop in IV. What does that mean? Option prices are more expensive. You can get further out of the money for selling a put or a put spread, right? Or get a bigger credit for the same distance out of the money. You can see here on a kind of 25, or 20-day basis, right? The 25 delta put and call. Here is earnings, right? The usual run up in IV in front of earnings. Once the unknown becomes known, you see that vol crush. But because of the huge wallop, right, we saw in the stock, we now see IV basically at almost the same level it was before earnings. Just as importantly, put call, right? The difference on those that skew now at an extreme as well. Many times this signals a low in the stock. So it's at by far the highest level over the past 20 days. Another reason to maybe take a slightly bullish stance on Microsoft. So we're going to be looking to go out maybe to the March expiration here, right? Most people tend to play in that time frame. big option volume there as well as the liquidity. You can see March IV shot up 17 vol points from Wednesday to Thursday. You can see here on a longer term 6-month basis, the 60 delta, 30 delta or 60-day 30 delta put has exploded now to the highest IV, right? Even beating earnings over the past 6 months. So this absolutely sets up for an option sell. Take advantage of this huge spike in vol, right? That we look to temper back down here. And many times, as we know, these spikes in vol signify significant lows in the stock, as we have seen in the past. So I did a simple comparative, right? Going out Microsoft the last time it was here back, when the stock was trading at a similar level, right, and compared it to now. So the last time going back March the 5th, right, we saw the stock close at 388.61. So basically going back to kind of this time frame here, the stock at a very similar level, right? The only difference is IV has exploded recently, and we're taking advantage of that. So on March 5th, the stock was 388.61. The 350 put, right, the April expiration, right, which is a 43 days to expiration option, right, trading just over $3. It was out of the money by 38 points and change, or almost 10%, a little less than 10% out of the money, 43 days to expiration. As we said, IV just under 31. Fast forward to yesterday's close, the stock at 393.67, right? So basically 5 points higher than our comparative date going back to March the 5th, right? The 350 put, that same 350 put, now trading almost $4. Before it was trading around $3. So you're getting a much bigger price for that 350 put, even though the stock is 5 points higher, 5 points further out of the money. So that 350 put is now 43.67 out of the money. Before it was only 38.61. So 5 points further out of the money, right? You only have 42 days to expiration instead of 43. So basically one less day. Out of the money by over 11%, right? Before it was out of the money by just under 10%. So you can get further out of the money, get a much bigger premium. Why? Because you see this huge IV explosion from almost 40 to 30 where it was before. Another way to play the trade, right, is do a simple put spread, right, for those who like to find risk. So going back to that March 5th date, we can see that put spread was trading at just under $1, 96.5 cents. That's selling the 350 put, buying the 340 put. So you're risking, if you will, just under $9 to make a little bit less than $1. Fast forward to yesterday, that same put spread, even though it's 5 points further out of the money with one less day to go, is trading at almost $1.20. So under $1 to well over $1, right? Even though you have a bigger cushion and less time to expiration. Why? Because we see this huge increase in implied volatility. So taking advantage of the huge IV pop and the oversold condition, and the stock that's finally looking fairly well valued, I think makes sense. Give yourself plenty of cushion, selling out of the money put or put spread, giving yourself 10% downside, and the ability, if you sell this spread for $1, say 15, right? So let's say we're able to get $1.15 for that put spread, right? You're only risking $10 because that's the spread width, but you're bringing in that $1.15, so you have $8.85 a total at risk, right? That's your maximum loss and your margin requirement. But your return on that would be almost 13% return, as long as Microsoft, which has been absolutely walloped as we've seen here, doesn't have another 10% down move, and really structuring the trade right at this low level that we saw here that held nicely. So if it breaks here, you may want to look to close out the trade. So that's how we go about identifying trade opportunities using that fusion approach of fundamental, technical, and implied volatility analysis. So until next time, as always, here's to good trading. Take care.